Imagine a casino where the house doesn't always win. Imagine a game where the rules change every time you roll the dice. For 100 years, the stock market was a place where you bought a piece of a business, you waited 20 years, and you retired. It was boring. It was slow. It was logical. But look at us now. We have moved from the boardroom to the casino. We aren't analyzing balance sheets anymore. We are playing a massive, multiplayer video game with the global economy. In 2025, nearly 60% of all options volume on the S&P 500 expired in less than 24 hours. Think about what that means. Trillions of dollars aren't being invested in the future of American innovation. They are being bet on what the price will do between breakfast and lunch. We are witnessing a cultural and structural metamorphosis. We have transitioned from investing to gamification. In this video, we are going to expose the glitch in the financial system. We'll cover why a change in the Federal Reserve's motherboard, a psychological rewiring of the retail brain, and a new weapon called zero-day options have fundamentally broken the relationship between price and value. Is this the greatest bubble in human history? Or is this just the new normal? My name is Shavez Ahmed, and this is the story of how we gamified capital. Let's talk about video games. In gaming, there is a concept called a speedrun. It's when a player tries to beat a 40-hour game in 20 minutes by finding glitches in the code. They break the intended mechanics to skip the grind. For decades, wealth building was a grind. It was the compound interest level. You save money from your paycheck, you buy a boring index fund, you get 8% a year, and you wait 40 years. That is the intended way to play the game of capitalism. But a new generation of investors looked at that 40-year grind and said, no thanks. They wanted to beat the game now. Enter the glitch, high-leverage derivatives. Specifically, weekly and daily options. The modern retail trader, popularized on forums like Reddit's Wall Street Bets, isn't looking for a steady dividend check. They are looking for a 2,000% return by Friday. This is the capitalism speedrun. And the data proves it. In 2025, total options volume hit record highs. But the scary part isn't the volume. It's the lifespan of the bets. Back in the day, you bought an option to hedge a position for months. Today, you buy a zero-day to expiration contract. You are betting on the market's movement for the next 6 hours. It is the financial equivalent of a coin flip, but with your life savings on the line. This has turned finance into a spectator sport. We call this the screenshot culture. In the old world, if you made money, you kept it quiet. In the new world, the victory isn't real until it is shared. The immediate posting of the gain pawn, a screenshot of the portfolio spiking green, validates the speedrun. It turns finance into a performative act. It is fueled by dopamine and social validation, not financial security. It's the Wheel of Fortune effect. When you spin a wheel, you don't analyze the physics of the spin, you just hope. And right now, the whole world is spinning the wheel. To understand how wild things have become, we have to look at the old world. We need to understand what we lost. For most of financial history, markets operated under a specific set of physical laws. The most important one was gravity. We called it mean reversion. In the old world, a stock price was tethered to an anchor. That anchor was reality. That reality consisted of boring adult stuff, earnings, cash flows, and economic data. If a company earned $100 million, it couldn't trade like it earned $10 billion forever. Eventually, the hype storm would pass, and the anchor, the math, would pull the price back down. This was the social contract of investing. We all agreed that, eventually, value matters. Even the speculators knew that, at some point, they had to sell their shares to someone who actually cared about the business's profits. History is littered with people who thought they could defy gravity. In the 1970s, it was the Nifty 50, a group of stocks that investors believed they could hold forever, regardless of price. They crashed. In 2000, it was the dot-com bubble. Companies were valued on clicks and eyeballs instead of revenue. When the cash ran out, the gravity of traditional valuation crushed them. The lesson was always the same. You can mock the fundamentals for a year, maybe two. You can post memes, you can ignore the warnings. But you cannot ignore the math forever. Intrinsic value, what a thing is actually worth, always won in the end. At least, that's what the textbooks say. But what if the textbooks are wrong? Post-2020, the market didn't just crash and recover. It underwent a rewiring. The connection between price and value wasn't just stretched, it was severed. Why? Because risk was effectively outlawed. When the pandemic hit, the Federal Reserve fired up the money printer. They taught investors a dangerous lesson. Stocks only go up isn't just a meme, it's government policy. Buy the dip used to be a strategy. You had to analyze the dip and decide if it was safe. Post-2020, buy the dip became a Pavlovian reflex. Why research a company when the central bank will save you? I like to describe the current market as two roommates living in the same house, but they aren't on speaking terms. Roommate 1 is the fundamentals. The company is losing money, inflation is high, the economy is slowing. Roommate 2 is the stock price. The stock is hitting all-time highs. They occupy the same space, the ticker symbol, but they are ignoring each other completely. The price is no longer reacting to the data. It is reacting to liquidity and narrative. This creates a trap for experienced investors. In a rational world, experience is an asset. But in a broken market, experience is a liability. Look at Michael Burry, the guy from The Big Short. He looked at the market in 2021, saw that the math didn't work, and bet against it. He lost, not because he was wrong about the math, but because the market stopped caring about the math. When the rules of the game change from chess to hungry hippos, the grandmaster chess player will lose to the toddler smashing the buttons. So, if value is dead, what replaced it? Psychology. For 40 years, we believed markets were efficient. We thought investors were rational calculators. Today, we know the market's operating system is pure behavioral finance. It's no longer about earnings per share. It's about stories per share. We value narratives, not companies. We have moved from the efficient market hypothesis to the emotional market hypothesis. And this new system runs on 3 bugs in the human brain. First, loss aversion. The pain of losing money is twice as intense as the pleasure of gaining it. This causes panic selling that math can't predict. Second, herding. Humans have a biological need to follow the crowd. If everyone is buying a stock, your rational brain turns off and your primal brain says, join them. And third, anchoring to narratives. Look at how we trade now. The most critical question an investor asks today isn't, what is the intrinsic value of this company? The question is, how will other people react to this headline? It is a game of predicting other people's emotions, not analyzing business performance. It is a hall of mirrors.
So, where does this leave us? We are standing at a crossroads between two realities. Possibility A, this is the mother of all bubbles. History is a circle. We saw this in 1929, we saw it in 1999. The gamification, the speed runs, the disregard for gravity, it's all a sugar high. Eventually, the liquidity will dry up, and the brutal gravity of math will crash the system. The old world will return with a vengeance, and the new generation of gamblers will be wiped out. Possibility B, the regime has changed. Maybe the rules are different this time. With infinite central bank support, instant global trading, and the dominance of passive flows, maybe valuation is obsolete. Maybe the market is no longer a weighing machine for cash flows, but a voting machine for attention. The asset with the most eyeballs wins. If possibility B is true, then the casino isn't a bug, it's the new feature. The question you have to ask yourself isn't, what is this stock?
K-worth? The question is, are you an investor or are you a player? My advice? Chuckles, learn the difference between gambling and gardening. Because when the music stops, you don't want to be the one holding the empty bag of chips. I'm Shavez Ahmed, And this is Sandhu Financials. We're excited. If you want to survive the speedrun, hit that subscribe button. See you in the lobby.